All right, so here's what everybody's getting wrong about interest rates. Everyone here is obsessed with the Bank of Canada. Every time the Bank of Canada has one of their interest rate announcements, the real estate community and consumers just seem to jump all over it. But here is the misconception that I'm seeing. I think most people understand that here in Canada, we have primarily two types of mortgage products. You have your variable rate, which is a floating interest rate, it changes. And then you also have a fixed rate mortgage product, which is locked in typically for 5 years. Now, when the Bank of Canada makes a change to its overnight lending rate, that primarily impacts variable rate mortgages. However, if you are somebody who is planning to get a fixed rate mortgage in the future, the interest rate on that product is priced off Canadian government bond yields, and that is a market rate. It is determined by the buyers and sellers of bonds, the supply and demand of bonds. And these two interest rates don't have to work in tandem. They can diverge. And we've seen that this year in countries around the world where the central bank would actually lower interest rates, the overnight lending rate in a certain country, and the bond yields would actually spike higher. Moral of the story, if you are somebody who is looking to get a fixed rate mortgage in the future, spend more time looking at bond yields, spend less time looking at the Bank of Canada.